9:30 a.m. The market opens. Everything seems normal. Screens lit up. Orders flowing. Thousands of trades executing in milliseconds. Routine, precision, control, and then, in seconds, something starts to go wrong. Orders appear where they shouldn't. Massive buzz. Illogical sells. Prices moving for no apparent reason. At first it looks like noise. A minor anomaly. But it isn't. In just 45 minutes, a billion-dollar company was destroyed. They weren't hacked. They did it to themselves. And they couldn't stop it. The algorithm that didn't know it was wrong. 9:31 a.m. The orders keep going out. Automatically. Without real validation. Without pause. The system is buying shares. And selling them seconds later. At worse and worse prices. Repeating the cycle. Over and over and over. Every second they were losing millions. The traders are watching. Confused. Trying to understand. Is this a market error? An external problem? But the answer is worse, the problem is inside. 9:32 a.m. Volume spikes. Knight begins dominating activity across multiple stocks. But not with strategy. With choice. Buying high. Selling low. Repeating. Amplifying. Escalating. The algorithm doesn't stop. Doesn't hesitate. Doesn't question. It just executes. The algorithm didn't know it was wrong. 9:36 a.m. Prices in the market begin to distort. Stocks that normally move slowly spiked. Other market participants notice. But they don't understand the cause. Inside Knight, panic starts to appear. Not immediately, but it filters through. Because the losses are no longer small. They are cumulative, explosive, and the people watching couldn't stop it. Why they couldn't stop it? To understand why they couldn't stop it, you have to go back. Because this didn't start that day. Knight Capital Group was one of the most important automated trading firms in the United States. Not unknown, not small. It was market infrastructure. It executed trades for others. Provided liquidity. It was at the center of the system. And like many modern firms, it depended entirely on software. Algorithms. Code. Systems designed to react faster than any human. That was its advantage. And its greatest risk. For years, that system worked. Precise. Efficient. Profitable. It built trust. Because when something works consistently, it stops being questioned. That's the illusion that the system will always work. 9:38 a.m. Intervention attempts fail. Shutting down the system isn't immediate. Not a button. Not a simple action. It's a complex network of processes. And now all of them are active. The problem is no longer technical. It's structural. Because the system was designed for speed, not for manual control in a crisis. 9:44 a.m. Engineers find something, a recent code deployment. An update implemented hours before market open. But not on all servers. Only on some. That created an inconsistency, where part of the system was running new logic. And another part was running old logic. And that old logic contained a forgotten function. Obsolete code. Designed for internal testing. Never for production. But now it was live. Executing in real time. With real money. Human error. Automated system. The perfect combination for disaster. The numbers 9:45 a.m. Losses cross $100 million. In minutes. No clear precedent. No friction. No resistance. The algorithm doesn't tire. Doesn't reduce intensity. Doesn't reconsider. It just executes instructions. Every second cost millions. 9:52 a.m. They finally managed to shut down parts of the system. But not completely. Some processes are still running. The fragmentation makes everything harder. There's no central switch. No absolute control. Only multiple points of failure. 955. Losses approach 300 million. And keep climbing. 1015. Finally, the system stops. Completely. Silence. After 45 minutes of chaos. But the silence isn't relief. It's confirmation. The damage is irreversible. $440 million lost. In less than an hour. In just 45 minutes. $1 billion company was destroyed. The final collapse, but the collapse doesn't end there. Because the losses aren't just numbers. They are consequences. Knight Capital Group didn't have enough capital to absorb that blow. Not at that scale. Not in that time. Trust disappears quickly. Clients. Partners. Market. Everyone reeks. Because if a firm like this can fail that way, the risk is systemic. Within days, Knight seeks a rescue. Emergency capital. Investors willing to intervene. But at a high cost. They lose control. Massive dilution. The company stops being what it was. Eventually, it's absorbed. Disappears as an independent entity. Not in an immediate visible collapse, but in a structural disappearance. All in 45 minutes. The system, but the most unsettling point isn't the loss. It's the cause. Not a hack. Not an external attack. Not an unpredictable market event. It was code. Internal. Known. Badly deployed. It was a system that did exactly what it was told. Without questioning. Without validating context. Without understanding consequences. The system didn't fail. It worked exactly as designed. Without control, that's the real risk. Not when the system fails. But when it works. Without adequate limits. Knight wasn't destroyed by extreme complexity. But by something simpler: lack of control in an automated system. Because when you delegate decisions to machines, speed increases. But tolerance for error disappears. And when the error occurs, there's no time to react. And the people watching couldn't stop it. That's the real collapse. Not financial, but of control. Because in those 45 minutes, no one was really in charge. Just watching, while the machine executed. And executed. And executed. The algorithm didn't know it was wrong. That's the most disturbing part. Because the systems of the future will be faster. More autonomous. More interconnected. And the question Knight Capital leaves isn't about a past error. It's about a vulnerability that is still present. 45 minutes. $440 million. And no one could stop it.